Thanks so much, Rachel, and thanks everybody for taking the time to jump on and have a listen. And normally these sessions are best, with a lot of questions at the end. So I'll certainly run through all the information that I've got here, which is obviously outlined in the slides, and try to throw in some personal experience. Plus we're in the middle of raising capital for, I am anyway, actively with 6 or 8 companies. So we're sort of live in market at the moment, and seeing what's going. So just a quick one on who OnMarket is. OnMarket are a company I've worked with on and off over the years, back on when I was sitting on the founder side of the fence and raising money. So their life started inside the ASX as a book build company, and a place that pre-IPO businesses went to build up their shareholder numbers to that minimum required 300 shareholders in order to list your business. And that was probably when I first came across these guys, when I was listing my business. So from there, they spun out on their own, became a standalone business, and then took up a crowdfunding license when they were released by Turnbull, I think back in like 18 or something, and have since built a database of over 50,000 very active retail investors. On top of that, we've got a database of 500-600 plus high net worth individuals that we can take offers to, and then the final layer on top of that is the family offices, boutique funds, and VCs. So in short, OnMarket's able to take companies all the way from a seed round, where we might be doing $200,000 or $300,000, whether it be through a crowd fund or through the wholesale or the high net worth network, all the way through to your IPO. We're still involved in well over 60% of all IPOs that happen on the ASX today, through trying to build out their spread and help raise, we get allocation to help raise part of the funds for it. So the founding team, of which I'm not one, but there's 4 people in Sydney, got very deep experience across capital markets, corporate law, ASX, ASIC, all the governance and fiduciary stuff that's required. So overall, it's probably the most rounded capital advisory firm in Australia, and certainly a leading one. So, we take a lot of clients all the way through and remain as a part of their capital advisory for 12 months, 24 months, whatever is required. Can you jump to the next slide, Rachel? So what are investors looking for today? And when I'm talking about today, I think it's still the same pre-COVID, post-COVID, during COVID, right? So, and it also is very dependent on, where you're at in your business cycle. So your pre-revenue, early revenue, post-revenue. So where do you fit in the whole scheme of things? But regardless of that, investors are always looking for something different. They're always looking, Australia's notoriously conservative when it comes to investment. So they're always looking for companies that have got traction or showing growth, or have got a very clear channel or path to growth. A very clear market opportunity. There's some revenue or validation of the business. I can come back to some of this a bit later. And I think importantly, the quality, the credibility of your management team and your board are super important when it comes to, attracting good money here in Australia. So maybe none of that's a surprise to some, but that's certainly the very consistent feedback and commentary we get from the market. Rachel, next slide. It's the stages. I'm going to push through some of these ones quite quickly so we can get to what the purpose of the call is to talk about the different sort of investment options. So I think identifying the stage that you're at as a business, there's obviously a cycle that we're all aware of, from family, friends, where you can sort of raise, typically it's around that sort of 100 mark. Sometimes you can get up to that 200, 250,000 before you have to move on to, some of the more external professional investors, angels or grants or accelerator money, seed, all the way through to your IPO or exit. So, and as you can see there on that, OnMarket's we bridge a little bit into the angel side of stuff, but not a great deal. We tend to work with the angel groups to raise money in a co-investment relationship. So where we really kick in is through seed to IPO side of stuff, and they're sort of different, and a lot of these are just our view. There's different definitions around seed and A and B rounds and all of that sort of stuff. But these are the kind of rules that, you know, or the guidelines that we use as a business when it comes to capital raising. So on to the next one, Rachel. So what sort of capital is available in the market, and what are we kind of, you know, seeing, particularly pre-COVID, and now that we're coming out the other side of, you know, of COVID? You know, from my side, I think there's a whole bunch of exotic types of capital that are available in the market, but in the Australian market, and certainly in the US and European market, you know, your typical kind of money is your convertible note, debt. I know debt's becoming quite a big thing here. I'll say up front, I don't have a massive amount of experience in this debt financing sort of market, but I know I've certainly been approached by a few people in relation to debt as an option for, instead of trying to raise money. I'll talk about that, my opinions on that in a moment. Equity crowdfunding is obviously, you know, really starting to gain, you know, traction and acceptance. I think there's some misconceptions around what equity crowdfunding is and what it means, and I'll come back and touch on that. And then there's your pretty standard wholesale equity raise. You know, so the worlds that OnMarket play in, and certainly the worlds that I have knowledge of, the convertible note, equity crowdfunding, and wholesale equity raises. So when and why would you use a convertible note? For me, it's a convertible notes that I've used or issued to the market have really been more associated to a bridging round. Like I might be heading for a much bigger raise, but I'm waiting for a couple of substantial deals to drop, or contracts, or I'm waiting for a particular milestone within my business to be achieved. But in order to get there, I need 300 grand or 200 grand or 500 grand, you know, whatever it might be. So I'll issue a note. And again, depending on what your capital table's like and who your investors are and who the people are on your capital table, my experience is that I've always issued my notes back to my existing shareholders to bridge me through. And then that note, I've always controlled the conversion on the note, which is the best thing that you can do from a CEO founder point of view, and knowing that they're going to convert into the next raise. So it may be that I need, you know, 300 grand for the next 8 weeks or 10 weeks in order to get to that $3 million raise that I've got planned. But I know the only way that my $3 million raise is going to be successful is if I can secure a couple of these deals before I go to market. Right, so I typically use convertible notes in that fashion. I know some people use them because they see it as a way of not diluting, and just being able to get some cash into the business, you know. And it might be a 2-year convertible note, have the coupon, you know, that's paying interest on that, you know. And sometimes there's a pool of investors out there that find convertible notes to be a very attractive option. They prefer the ability to take their interest rate, which is usually a couple of points above bank rate, take that and take their money back at the end of 12 months or 24 months. So, you know, I think the only issues I find with convertible notes with some companies out there is that I've seen multiple notes in market with different terms. I've seen it where the companies control the conversion or the investor controls the conversion. My pretty simple rule, and it doesn't always play out this way, is that, you know, you as the company issue the note, they're your terms. You only have a single note in the market. They're all identical so that there's no confusion, and you try and get the note where the coupon is converts to equity upon conversion, as opposed to having to pay it on a monthly basis or a per annum basis. So they're all sort of ideal world views that I have. But you definitely, if you can get the people that, you know, that take the note to auto convert into your next, you know, your wholesale raise, then that's your ideal kind of situation. The downsides to notes, of course, is it's a debt facility. It sits on your balance sheet as a debt, and the risk of that debt's depending on who controls the conversion. So if the note holder's controlling the conversion, they can arguably call their note in and want their money back at any time. Whereas if you control the conversion, that can't happen. So it's just managing that risk side of stuff. But a convertible note, whilst very attractive to some people because it typically offers a discount to the next raise because it's risky money, and it has an interest rate better than the bank rate, then it can be an attractive proposition. We've got several notes in the market at the moment, and they are filling and they are gaining traction with the investors that we're talking to. So they're definitely a good instrument. We've also found we tried to do a couple of wholesale raises over Zoom and pitching companies and trying to raise $1-2 million, and it's been very challenging to say the least. It hasn't been enormously successful over Zoom, so we pivoted some of those clients back to a note to get them some short-term funding until such a time that we can start jumping on planes again to do roadshows. So we're hoping that window will reopen August, September, but fingers crossed, the Victorian thing gets under control. So that's on the convertible note side of stuff. On debt's a very new. I'm not a fan of debt. I with my last business, I did have an overdraft facility, but not because we pursued it. The bank just offered it to us. So we took it, never really had any reason to use it, but that's the sort of closest thing I've ever come to debt. But I know there is a bunch of companies out there floating around pushing debt as an option for the startup and growth companies. Again, these are my opinions and everyone's got their own views on this, so it's certainly not advice on debt. I just, unless you desperately need to do it, I just wouldn't go there. Because the terms I've seen, the interest rates I've seen, the poison pills in the agreements I've seen, which again are very limited, have not been attractive. And I see the debt thing as more of a desperate move, as opposed to something that, I just wouldn't do it if I was a founder or running a company. I just wouldn't do that sort of thing. So, but everyone has their different sort of risk side of stuff. And typically this debt you have to personally guarantee, which as a director of a business or a founder of a company or the CEO of a company, you never want to guarantee anything. To have it come back on you. So debt, I'm going to leave to the side. People are looking at it, get your advice, talk to your lawyers, talk to your accountants, and make sure you're fully informed before you head down that road. Is on that side. Equity crowdfunding, I think, is a really cool way to raise money. I know there's different views. I certainly hear a lot of different views that people have around equity crowdfunding. I think there's some bad taste left over from the very early Wild West days of this, where, there was, control issues, type of money, quality of money, having hundreds of new shareholders and things on your cap table that had to be managed and all of those sort of things. I think, and some of them are valid and some of them are still valid today. But I still think it's, a really good way to raise money. It's only certain companies, I think, that will do successful equity crowdfunding, typically consumer focused. People like to be able to go and buy the product because it can also be used as a bit of a marketing tool. You've seen some equity crowdfunding, where they've had, 2,000-3,000 new shareholders, come onto their cap table through the crowd raise, but they've also all gone out and bought the product. Right. So, in some ways it can be, it can be good in those ways, but, we certainly look at companies on a case-by-case basis to determine whether it's a equity crowdfunding would succeed or whether or not it's better off doing the same raise, but with wholesale investors, so we can pick up the phone to some high net worths and try and raise the 250, the 500, the 700. I also think crowdfunding, it's very restricted to the seed level of funding. So I think overall nationally across all the crowdfund platforms out there, I think the average raise is around the 450,000 mark. I think at OnMarket, we're above the 600,000 as an average. So you've got to consider the amount of money you're trying to raise, what you're going to use it for, what's the use of funds, and definitely have a plan in place for your wholesale, depending on how long that, your crowdfund money lasts. So some of the negatives I hear around equity crowdfunding, which I kind of wouldn't mind addressing, is some people go, oh, I don't really want 500 shareholders or 1,000 shareholders on my cap table. It's what a nightmare. I said, well, my view of that is, when did a shareholder ever become a nightmare? Firstly, they've given you, as a business, their hard-earned cash, and they're relying on you to, turn their $1,000 into $10,000 over the next couple of years. Plus the more shareholders you have on your cap table, if you need to issue a note, the greater chance you've got of successfully closing that note. And also going back to your existing shareholders to raise additional funds if you need to. So from my opinion, I look at running a public listed company where I had 13,000 shareholders. I could go back and raise money the whole time, right? They were never a pain in the neck to me. If I was doing the wrong thing or letting them down or not meeting the expectations, then yeah, I'd cop it in the neck. But that didn't matter whether it was 10 shareholders or 10,000 shareholders. That's going to happen when it comes to, using other people's money to grow your business. So, plus there's platforms out there like Boardroom who can manage your cap table, can manage all your ASIC filings, can manage all your communication to shareholders, and can take a lot of that pressure off, as the founder or CEO, when it comes to managing those investors. So, I think, the whole notion that investors having 300 or 500 or 5,000 shareholders is difficult. Well, I guess it depends on your view, but I've never considered investors to be difficult people, particularly when it's helping grow my idea or my vision of what I'm trying to do. So I think equity crowdfunding should be a serious consideration, particularly when you're talking to me or talking to anyone at OnMarket or crowdfunding. We just don't push everybody to a crowdfund. We have a very close look at their business and determine the best form of capital, whether it's a note, crowdfund or wholesale raise. So that's the bit on equity crowdfunding. Happy to answer some more questions on that later, but it's certainly a growing area of interest when it comes to raising money. Also understand equity crowdfunding is done under the short form prospectus. So the rules and the governance around doing an equity crowdfunding is no different to doing an IPO. It's really strict, and it's really strict on us as a business and our AFSL license, right? So there's not, so everybody's protected. And I think it's a really important thing to keep in mind when it comes to, crowdfunding. It's when Turnbull put this to market, he said, all right, look, let's do this, but we've still got to protect the mum and dad retail investors. So we need to make sure, this is done under a short form prospectus. So it's very heavily driven by the Corporations Act and ASIC as to how these things are approached, which is why we take it always a crowdfund so seriously, which is one of the key differences with a wholesale raise, because when you're dealing with high net worth investors who are sophisticated or experienced, the government's sort of view and ASIC's view is, whilst there's very strict rules around as businesses what we need to do with that money, the government kind of considers these people have been successful enough already to be smart enough to make their own decisions and not be misled like the retail investor could be. Right, so that's why it's the rules of, you can issue an information memorandum with disclaimers and go out to the, to your sophisticated investor network, and, they do their own due diligence, they do their own review of the business, ask all the questions they want to ask to determine whether they're wanting to, their risk appetite meets what you're looking for, and then determine to, then write a check. Whereas, your crowdfunding, they're relying on the information that's in the IM and the video that's up on the platform to make a decision. They don't necessarily get an opportunity to talk to the founder, CEO or management team of the particular company raising money. And your wholesale raise, you obviously end up with a smaller group of people, hopefully with larger checks, but are also the type of people that can follow on, in later rounds, or can help with some bridging finance through a convertible note. Now wholesale investors and sophisticated investors can invest obviously through an equity crowd fund. Our experience is that, they typically like to be approached directly and treated just a little bit more personally than through that sort of crowdfunding model. So they're really the four primary ways of raising money here. in the country. Obviously, we've left family and friends off and angels on this sort of stuff because we figure they can probably come in if you don't have a round done with those people. Now they can probably come in through an equity crowd fund. Otherwise, you know, you mightn't be ready for these sort of capital raising side of things. So, you know, it could just be way too early for any of it. That's really, and sorry, just the final thing on wholesale raise. So a wholesale equity raise can be seed, can be A, B, can be pre-IPO. So it's all the way kind of through it. And the wholesale raise includes not just your high net worths, but it also includes your family office, boutique funds and VCs and those sort of institutional money that come through an equity raise, again, depending on where you sit on that, you know, business cycle slide that we showed earlier. So they're the sort of four areas. We're seeing the market, you know, we're successfully raising at the moment. For companies, we're finding things are certainly slower. And we're finding the due diligence process is becoming very rigorous, and the expectations that the check writers are having around that due diligence process is becoming, you know, tough. Now, is it valid? I don't know. I mean, you know, when you're talking about other people's money, I guess they can kind of ask for whatever they want. You know, you can make a decision as the founder or executive team as to whether you want to provide all of that information. But if you're seriously trying to raise money, particularly as you start to get up into your Series A type check sizes, so $1 million plus, the due diligence process just gets, you know, tougher and tougher as you go along. Can you go to the next slide, please, Rachel? Capital raising mindset. You know, I think there's a few things to keep in mind in any form of capital raising. You know, you've got to allocate a budget. Capital raising is not a cheap or free process to go through. You'll pay someone, somewhere, something in order to get you prepared for a raise. Now, again, what's required varies as you head down the capital raise cycle and levels, right? Families and friends, the due diligence is probably nowhere near as tough as, or it isn't anywhere near as tough as an IPO due diligence process. And then you've got kind of everything in between. So it's really critical that you allocate a budget and the resources to do a capital raise. It's a full-time job, raising money, and it's massively distracting for the CEO. And so, you know, you need to be very, very aware of that side of things. And, you know, a part of that whole process is also working out what your forecast budgets are, what capital requirements have you got in the next 3 months, 12 months, 24 months in order to achieve the outcomes you're planning to achieve, and can you pressure test that? And can you demonstrate that, you know, the money that you try to raise is going to achieve those outcomes, and there's going to be minimal, you know, sort of wastage along the way. The required level of investor readiness, you just got to ask yourself the question, right? I mean, you know, I do it a lot, is I put my investor hat on and go, well, would I invest in this business? And if I like what the business is doing, what do I want to see? What do I expect? What level of governance and fiduciary documentation have they got? What level of planning and budgetary stuff? Who's their executive team? What's their management team, right? So that all bundles into this whole investment readiness side of stuff. I mean, I regularly hear, and I used to, you know, similar, is that, you know, founders often talk about the fact there's no money in the market to invest in my business. And then the second side of it is I talk to a lot of check writers who tell me there's not enough quality deals, right? So, and the gap is this investor readiness piece, because typically, you know, companies are at a certain level of readiness, but not sufficient to meet the investment criteria of the high net worth or the family office or the VC that you're talking to, right? So it's about trying to line that sort of stuff up, and there's costs associated with investor readiness. And, you know, and then, you know, do you have the support to guide you through this process? So who's your accountants? Who are your lawyers? Who are your advisors? Who's helping you get through this capital raise process? You know, so they're all the things to consider before you kind of head into to the market. But, you know, to me, raising money is a very serious endeavour. It's not something you add to your to-do list one day, you know, and it's an ongoing endeavour. If you're a high growth company going global, you are constantly getting yourself ready to raise money until you hit that, you know, wonderful time where you go to break even and you no longer need money, which is the ideal scenario for all founders, right? But what I've always found with my companies is that I get to that point, and then all of a sudden I want to buy a company, or I want to expand into Europe, or I found this new market I want to go into, so I need to raise money in order to achieve those type of things. So that's why I say the investor readiness, your data room and your decks and your communication to your existing shareholder base has to be ongoing. Right, and you have to be ready to go at any time. Look at COVID comes along, right? You know, there's a lot of companies I've spoken to who weren't financially prepared for COVID. Their business fell off a cliff, understandably, and for no fault of their own, which I find even more disappointing for these people. But they weren't ready to go and raise money. Right, so we couldn't move fast enough to get money raised. So this is why it's an ongoing endeavour, and you know, you need to put it in as a very key part of your day-to-day side of things. Things to keep in mind, you know, or things to remember when you're trying to raise money is that there's some pretty strict guidelines out there to protect investors. Plus, your documentation needs to be your constitution. If you use a shareholders agreement, your shareholders agreement. Most companies don't need a shareholders agreement. Our constitution does the job, but mate, you know, in there are all your investor protections, all your down raise stuff, all of your, you know, your tag along and drag along rights and minority shareholder protections. You've got to make sure all that's there, but you've also got to make sure the rules of engagement are there that are protecting you, protecting your board. So it's not just all about the investor. You guys, you know, as your executive team and as your board need to make sure you've got your protections in place as well. Also remember that, you know, raising money is highly, highly competitive. Okay, I'm one of, you know, we've got, you know, I know of 6 companies that I'm working with that are all raising money at the moment, and we're small players. There is thousands of companies out there looking to raise money. It is massively competitive. That's why the preparation side of stuff is so important, because I know guys up here in Brisbane that are very, very active check writers. They're seeing 20 deals a week. Right, and these are just a few individuals that are getting these things into their inboxes. So always keep in mind that you're not the only company in the market trying to raise money. And, you know, of course, I've already touched on your capital raise requires both time and investment in order for it to be successful. Rachel, do you want to jump to the next slide? So what do you need to be ready? You need a clear business strategy. Does it pass the pub test? My view is that I run it past my 13-year-old daughter, and if she understands it, I'm about good to go. You know, corporate governance, pretty important. I've touched on this, constitutions. If you think you need a shareholders agreement, everyone's got their views on this stuff. Make sure that it's all squeaky clean. I've come across constitutions which are still the same ones that were issued when they registered their proprietary limited company. They're not shareholder-based constitutions, and there's no protections in place for anybody. You got to review this stuff, be very careful. Don't spend thousands of bucks getting a new one. I've got a dozen constitutions, right? They're all pretty cookie cutter, and you don't need to spend a huge amount of money to get one made. Your financials, make sure your tax returns are up to date. Make sure you've got, you know, all your management accounts are up to date. Your P&Ls are up to date. Your forecast budgets are done, and that those forecast budgets can be pressure tested in an investor meeting. And if you've got revenue month 27 on June, for example, why have you got that number there? And what's the basis behind it? Make sure your capital structure's tidy, all your asset records are up to date, your cap table's clean, you know who they are, you know who owns what, all the paperwork signed and executed, your IM, pitch deck, investor videos, all up to date. The information's consistent across your data room, your websites, and every piece of communication that's out there. You know, data room's really, really important. Again, if you haven't got one, you know, it's a fairly, you know, it's cookie cutter again as to what sort of information needs to be in there. The importance of the data room is to make sure that it's up to date. It's a live, living environment, and it needs to be maintained constantly. So they're the sort of things that need to be done to be ready, I believe, for any form of capital raise. It also demonstrates how serious you will raise of other people is if you do stuff. One of the first questions the investors in our or is a link to the data room. They won't even have a meeting until they've been through your data room. And so a lot of that stuff that's on this list here is what needs to be in your data room. Next slide, Rachel. A bit of basic stats around equity crowdfunding, which I sort of touched on in earlier. I won't go into this in a great amount of detail, but you can see, the sort of averages. This is just Australian wide. There's been some big ones. There's been some solid Sheba, $3 million, which was a real knockout of the park one, right through to a DC Power with 14,000 investors, which was the largest ever. But the good thing for DC Power is that they were a solar business that just all of a sudden got 14,956 new customers. Right, so it's a pretty good marketing play for those guys, particularly with the incentives around solar installation these days. So that just gives you a good snapshot of what's going on in the market over the past couple of years. Next slide, Rachel. What's worked at OnMarket? As I was touched on before, consumer-focused products are pretty good. Ones that we've had, like Solar D, the blockout company, as Matt's had some pretty good success raising, because people can go out and buy the product at Woolies or Chemist Warehouse or anywhere else. So, they do like that, and technology side of stuff. So, we've, over the past couple of years, we've had a lot of success. We have an 87% success rate in our capital raising. And we're above the average, as I said before. I think around, north of 600,000 is our average sort of crowd raise, which is a pretty good seed round, I would say. That's about all on that side, Rachel. The next slide, please. Oh, the team. So you got Ben, Nick, Rosemary and Tim are all of the founders. You can read their stuff there. William's in there with his equity capital markets experience, and I did a deal with OnMarket about 3 or 4 months ago to open up their Queensland office, because I was sending a lot of deals their way and figured I might as well just try and manage it up here and get more involved in the OnMarket side of stuff, because I'd actually run out of ideas for myself to find, to go and set up another business. So I changed sides of the fence, and, hopefully doing that, I can bring a lot of my own personal experience in running companies and growing them globally, failing as well as succeeding, to everybody at River City Labs, as well as bring in a really solid, robust and active investor group that we've got at OnMarket. Plus, working with us gives you access to the whole team. We've also got analysts on payroll in Sydney, and a whole group of other people that we sort of wrap around any deals that we do. I think that's about it, Rachel. I don't think there's any slides after that. No. The usual, don't point at me thing. So that's it, guys. So, thanks for listening. I'm not sure how the best way to handle the queue. Oh, you're just going to take everybody off mute, aren't you?
Yeah, so if you have any questions, feel free to unmute yourself and we can get through some questions.
Not a question from me, but I'll just say thanks for that, because it was very informative, and cool. We're going to obviously talk a little bit further very shortly anyway. Yeah, no, thanks, Paul. I hope it was informative. It's always a difficult thing, the whole capital raising, because there's no black and white, clear cut sort of approach, right? Every business comes with its own DNA, its own fingerprint, and and investors are notoriously fickle sort of people, which I can understand. They've worked hard to make a chunk of change, which they're now happy to go and invest into some high risk, or medium risk companies, and it's got to be treated as such when it comes to approaching and talking to these people. And I, having been through many successful and failed capital raises and looking back as to what's worked and what's not worked, I
think I've got a reasonably good handle on the whole thing and how serious it is to get it right. You know, and finding the right investors, right? You've got to have the right people for your company that are going to help your company grow and also hopefully follow on invest and, you know, and continue to be full supporters of the business. You know, so it's not, there's no clear cut single answer to a successful cap raise or a failed cap raise. You know, there's plenty of conversations we can have. I had a recent very failed cap raise last year through Asia, and we sat back and had a look at it and wondered what went wrong. I won't go into the details of it here, but it was very, very curious what we identified went wrong with the whole raise. You know, we ended up raising money successfully post that, but, you know, we really thought we were going to knock it out of the park on our Hong Kong, Singapore roadshow. Not to be the case, so, but I can talk about that one another time, but it was a curious learning for all of us involved in that. So is there any other? Yeah.
Anthony, Susie George from Sport Tech, how you going?
I'm good.
Good to see you again.
Yeah.
Thank you. Or you can't see me at the moment, but good to see you. Thanks for today. That was just a really good sum up, and I think we hear a lot of the same pieces of information, perhaps presented slightly differently, but I think you can never hear it too many times because it just, and everyone has a slightly different take on it. Sometimes you need a different take for it to sink in. Could you speak a little bit more around, I guess, the stages, for the different stages of capital raising? So the business readiness sort of, I guess, roadblocks or markers that you'd be looking at for the different ticket sizes or different types of capital? Yeah,
that's a good question, Susie. It's challenging because, you know, you'll know the company I was talking about anyway. You know, sometimes having contracts that give you a clear line of sight to revenue are sufficient to go and raise millions of dollars on a reasonably good valuation, because you need the money in order to achieve the outcomes, but you've got the exclusive contracts in place in order to go and execute on them, right? And I'm seeing that with a couple of other companies at the moment. So sometimes that can be good enough for the replacement of kind of the revenue argument, right? Is because, well, look, the revenue's here. This client's committed to do this, it's going to generate this much income. But in order for me to do that, I need to hire these people, do this, build that, so I can deliver on what this agreement says that I can deliver on. And other times it's just purely about revenue. But if you talk to the different sort of stages, you know, of it all, you know, convertible notes can be good, like crowdfunding for a seed round, right? So, you know, you could be early pre-revenue, you can have some proof points, you could have some customers on board that are giving you, you know, the heads up. It might be that they're on a 60-day trial and subject to a few things being met, it's going to convert to revenue that's going to equal, you know, a range of other, you know, bits of revenue that then can expand you out. So it was like I was saying before, it's, you need to assess everything, you know, as it kind of goes. Each business, you've got to look at it on its merit and have a look. It's in the whole argument around, you know, kind of valuation is always a sort of difficult one, right? But I look at it, when we look at valuing companies, we look at similar businesses in the market. So I use the kind of analogy of a house, right? And you're all on a street and there's a guy on the street that thinks his house is worth $1 million, and yet every house is selling for 750 grand. And he's been offered 750 grand for his house. What's it worth? Right? It's not worth $1 million. It's worth 750 grand because that's what the person was prepared to pay for it. Right? Like in any situation, and an evaluation of a business is a very similar, you know, similar thing. But, you know, for me, you know, when you look at the type of capital raise, if you look at a seed round, which is typically that sort of $500 to $1 million mark as a rule of thumb, your valuation here in Australia is, you know, looking at, you know, between 3 and 5 million pre-money, pre-investment, right? If you use that as a guide for yourself, right? Then once you've got that as a starting point, then you go, well, hang on, I've got these contracts and these commitments from certain clients that will generate this much revenue over time, and it says so in the agreement. So I can probably push my valuation up a little bit and ask for a little bit more money, right? But we also then look at similar businesses in the market and see what they're comfortably attracting, you know, from a valuation point of view, and then from a capital raise point of view. So it's really sort of hard to define a lot of that sort of stuff. But I think if you look at equity crowdfunding and to a certain extent a convertible note as your seed round, your wholesale investors as your sort of A, B and beyond type round. But that doesn't mean you can't raise a seed round with the wholesale investors. So again, the crowd raise will be determined by the type of product and the type of business that you've got. And like you said, our best experience is tech and consumer. From an on-market point of view, I can't talk to the other players in the market, or we don't watch them that closely. And then the wholesale raise, well, one of the benefits of a wholesale raise, whether you're raising $250,000 or $2 million, is that we know our investors pretty well, because they've been a part of the on-market network since their pure ASX IPO days. So we've actually got a really good handle on, you know, if this is your business and we know these family offices and these individuals like this type of company and they will write, you know, 100 grand checks, then let's go and talk to them. So it's really just got to be assessed. It's what we call a capital strategy. It's like, well, okay, I'm going to need $1 million now. I'm going to need $3 million in 9 months. And I may, depending on what's going on, need another $5 million in 18 months, or I'm going to IPO. What's your financial budget forecasting telling you is going to happen if you get that money? What are the points where you need it? Because you've got to give yourself a good 5-6 months, right? Or have a continuous capital raising process going on behind the scenes to keep the market informed and warm in preparation for the next round. And then you need and then if you're looking to do an IPO, then making that decision as early as you can, because it takes you down a different path to staying private. Different documentation, different approach, different rigor, different focus. And the sooner I got forced into an IPO, it was never a plan for me, but I had to pivot as an example and do 2 years of back audits, right? And it cost me a lot of time and money to do it, but I was, you know, I was pushed into the situation as opposed to personally wanting to run a public company. But the point is, that's why for me, picking your path, picking your lane now is really important. Develop your strategy, develop your budgets around that, your entire planning, and then go, right, here's the road we're on. This is where we're going to head over the next 2.5 years. We're going to need 20 million bucks. So when do we raise it? Why do we raise it? What type of instrument do we use? Do we raise it here in Australia? Do we try to raise it in Asia or in the Northern Hemisphere? Where's the best place for us to go? All those sort of considerations have to come into play. I'm not trying to overcomplicate this for everybody. It's more a thought process when you're thinking about capital raising. You know, none of it's really that challenging. It's because it all changes. We're all in this crazy growth world, startup world. So things move and pivot and shift, you know, the whole time. But you kind of need to, it helps you sleep at night if you've got some sort of direction that you're heading. I hope that kind of answers your question, Susie.
Yeah, that's great. It's really great information. And one last question for me is just what revenue model does OnMarket work on, as far as if they work with a company individually? I guess, how does that sort of work commercially?
Yeah. So we're a fee for service sort of, so we position ourselves as capital advisors. We're not brokers. We don't have a broking desk. So we offer it's a fee for service model it's a monthly retainer. We've got a range of models that we can push, but typically we try to work with clients on a 12-month basis where, you know, the monthly fee goes up if we're in full capital raise mode, because it's highly intensive. On our side, we're doing a lot of phone calling, a lot of prep work, pre-due diligence work with investors. So by the time you get to a roadshow, you know, you're basically walking into very room. You know, we've qualified out all the people that aren't going to invest, and we're only taking you to people that have got a huge amount of interest and want to pepper the founder with questions and pressure test the financials and stuff. So that's intensive. And then the fee drops right off in the non-capital raising period, where we just remain talking to shareholders, communicating, identifying new ones based on the capital strategy that's in place. So we know that in 8 months, we've got to start the raise for the $3 million. We start preparing now. We make sure the IMs are refreshed, the data room's kept up to date. We offer business advice, you know, from across the board, because we see so much stuff that's going on out there, and talk to a lot of people. And then, so it's kind of that sort of model, but typically we find working on an ongoing, consistent basis. We've had some clients that just do the capital raise with us. It's finished, everything's done, the money's banked, and then they go away and they come back 6 months later for the next raise, and they've gone cold. Like, we almost have to start fresh again. We have to start market up, investors understanding the business, where's it got to, what's it done, why wasn't this achieved. So the more involved we stay from that advisory side of things, the better it is for, you know, the capital raising process is stressful enough as it is, as we all know. So the easier we can make it, the better all round. And that's through just a consistent, you know, development of a strategy for it.
Great, thank you.
And Anthony, we've got a question from Nick in the chat, and he says, or she says, sorry, could be unisex. Can you guys have a look at a company so we can know how close or how far away we are from investment?
Yeah, so we've got this sort of what would seem like a fairly basic questionnaire that we send people to fill out, but the questions are sufficient for us to determine where you're at as a business, and the outcome from that is one of three things: is let's sign an agreement straight away. You're on a, you know, you've got a massive opportunity ahead of you, and this is why. The other one is, we love what you're doing, but you're not ready. Here's a list of things you need to do to go and get yourselves ready. Let's stay in touch. And the third one is, we're just not interested. Just because, for whatever reasons, and we'll give the reasons. Like, it's not, we just don't sort of come back and go, yeah, no, we're not interested. We'll actually talk it through. And it doesn't mean the company can't pivot, you know, but we look at probably 60, 70 deals a month and work with 5 or 6 just as a guide. Doesn't mean we don't have a bunch of businesses in the pipeline that we're keeping warm and talking to and staying in touch with, but that's just kind of a guide as to, you know, the sort of percentages that we work with when it comes to working with companies. So we just don't, you know, because a big part of keeping our reputation intact is to making sure we've got a high conversion rate when it comes to capital raising. Plus, we don't want to waste everyone's time, effort and money if we don't think we can succeed for you. And we could just point people, and we, you know, I have pointed companies off in other directions where they might be able to get money, but it won't be through the OnMarket network.
Perfect. And I suppose a question that I've been asked as an RCL member is, if someone already has investment, given COVID, what should, as an advisor, what should startups and founders, I suppose, ask from their investors now if things have changed?
Yeah, it's a tough one, isn't it? You know, if you need bridging finance, then you've got to go back. I know a bunch of companies, and I know a bunch of investors, I won't name up here, some reasonably high profile guys who are writing a lot of checks to bridge their companies through this COVID period because they don't deserve to fail. Okay, so they've been forced into a situation which wasn't of their making. And so it's only, and we're seeing a lot of it on market. We're doing a lot of bridging rounds at the moment for public companies for the same reasons. You know, where they're just needing some bridging finance and hope to God that everything starts to normalise again, you know, in the next couple of months, and life can get back to some sort of normality. But I think you need to, you know, you got to make some tough decisions. And I think one of the, you know, the tough decisions could be around headcount. It could be around, do you go into some sort of, you know, semi-dormant state and continue to develop out your business and continue to keep it ticking over and continue to try and get, you know, clients across the line, or, you know, do you put it into dormant? And your worst case scenario is, you know, having a really good hard look in the mirror and go, well, can I actually recover from this on the other side, and how much more, time and effort do I put into this? So it becomes quite a sort of brutal exercise, right? It's almost like a trauma surgeon. Is that person actually going to survive, or should we focus on this person first? And I know a lot of investors are doing that, having that hard look at their portfolios at the moment. But if you need the money and you can come out the other end and you think there's enough appetite for your business, and I know a few companies like this at the moment that have got very genuine appetite for their business, they've just got to get through this until, face-to-face contact and things can start again. So they are successfully getting bridging money from their existing shareholders. So you've just got to put your argument forward.
Perfect. Thank you. Do we have any other questions?
No? Very good. Well, thanks everybody. Thanks Rachel and River City Labs for putting that together. I hope to and look forward to trying to meet everybody. I should be coming down to doing my 2.5 days a week, starting next week at River City Labs. So always up for some time to listen, have a chat, and talk some stuff through with people in and around the office. And I think my candidly things somewhere available for people to book into my diary, and my phone's always ringing. So, but thanks everyone for listening and for your questions. It was a good session.